Welcome everybody to Holistiplan's Gift of Giving webinar. My name is Ben Birken. I'm the Vice President for Customer Success and Engagement. I'm joined by my colleague, Madeline McFarlane, who is a Customer Success Specialist. If any of you have recently started your Holistiplan journey, you've been communicating with Madeline. She is the one who handles everybody as they first join Holistiplan and ushers them through, guides them through, I suppose is a better way of describing it, guides them through their first 30 days on the platform. We're super excited to have you all here. This is going to be one of the first, I think, feature-specific webinars that we've done at Holistiplan. We've done a lot of overviews before. We do tax updates, we do certain things like that, but this is one where we're going to be focusing on one specific thing within Holistiplan, and that's going to be on our charitable giving. So tips, tricks about how to model charitable giving. We're going to talk a little bit about some planning related things. This is not a CE eligible class or course. Next week we have another one about all the tax torpedoes that folks might want to be aware of. That is going to be CE eligible for CFP folks. So take a minute to register for that if you haven't already. And I'm going to share my screen here in just a minute, just so everybody knows we are recording this. We will send a recording to everybody who registered. So if you have to bail early because we aren't as exciting as what you might otherwise be doing during this time, we totally get it. General housekeeping, just like almost every Zoom webinar since last February, we've got the Q&A box and the chat box down below. Madeline will be personing or overseeing both of those boxes. If you've got a Q&A specific question, let's use that Q&A box. If you just want to use the chat for just general chit chat, like if you'd like to comment on my wide variety of books behind me, by all means, feel free to do so. But with that in mind, I'm going to share my screen. We're going to get started here. All right. So here we are. We are inside of Holistiplan. We are inside the dashboard. And keep in mind too, we're just talking about gifting, right? We are talking about gifting to the extent that there are other things that are non-gifting related. We'll see if we can touch on those. But if you have a question that is not gift related that we don't get to, I'll just throw out as a general reminder. We run office hours every 2 weeks. If you would like to participate in those office hours, on the dashboard screen itself, you can always sign up for them. So this is going to be my dashboard. I'm going to see every possible webinar that we're running. When you log in, you'll be able to see anything that you might be eligible to participate in. So here on the dashboard, here's the tax torpedoes. We see that this one is CE eligible, but note that we've got office hours coming up. Our next one is next Thursday. If all goes well, it will be another costumed one. So we had a costumed one in October for Halloween. We had a costumed one in November for Thanksgiving. It's December. So this will be, again, if it works out well, an ugly sweater session of office hours on December 23rd, right? So a couple of questions coming in. So for the tax torpedoes, how many CE credits is it? I believe it's eligible for 1 CE credit. So 1 hour of CFP credit, right? So within Holistiplan, when we talk about gifting, that's almost always going to be accessed through the scenario analysis screen. So I'm going to pull up one particular household. We have 2 that we like to work on when we're talking about gifting, or we're talking about anything when we work within office hours. But we'll pull up our affectionately titled Michael and Margaret office hours. And within here, we're going to go to scenario analysis. We've already uploaded a 2020 return for these folks. So when we come to scenario analysis, you'll see we've got their 2020 return already in here. You'll notice the return because it says 2020 return and none of the fields are editable, right? We can't click on them. We can't do anything. This is here partly for reference, but also partly so that when you build new scenarios for new baselines or in future years, you don't have to spend as much time typing in data, right? When we create a new scenario, if we just copy from scenario 1, everything's going to get copied over. What I always tell people when we create a brand new scenario, without a doubt, title the scenario, give the scenario a name. So we'll call this one 2021 baseline. The reason why you're going to want to do this is because as you create additional scenarios, it's going to be much easier to find what was different about this particular one if you give it a descriptive name. You can type something in the description, but the description is something that by design, you have to open it up to see it. So if you're just looking for something quick and dirty, if you can give your scenario a descriptive enough name, within this field. That's going to be a best practice. You're also going to want to change the year, right? So when we change the year from 2020 to 2021, a couple things are going to happen. You're going to get this option for the calculation type. There are 3 options: current law, 913 proposed, and 1119 passed. Current law is basically what's the law of the land right now. 1119 is what has passed the House in terms of the Build Back Better plan. Most of that stuff, in fact, I don't believe any of it has any impact on 2021 right now, but it certainly does on 2022. If for some reason you wanted to model stuff from the September 13th legislation, you certainly could. Don't know that there's as much value in that anymore, but you definitely can do stuff on the 1119 if you wanted to. But we're going to be working under current law. Okay. One of the things that I want to highlight, whenever we do any sort of scenario creation, you're going to see something up at the top here that says scenario contains at least one calculation override. Click to review. The word override is going to be an important thing when we're talking about charitable giving, because when we move information over from the uploaded return into these scenarios, everything comes over. But there are certain elements within the return where stuff we'd prefer to come over a slightly different way, but we can't for programming reasons. We can't break out all the things that we might want to. So we put stuff into an override field. And when something is in an override field, it does just that. That information overrides something else that might be calculated for that particular field. So if you see this at the header, at the top of your column, we want you to click on that so that you can identify what are some of the overrides that are in here. There are 3 overrides with this particular field that we want to pay attention to. The first one is total charity. That's super applicable to what we're going to talk about today. And we'll tell you what the name of the override is and any information about it. There's also QBI deduction and non-refundable tax credits. So at a bare minimum, what we think is going to be a best practice is when you see those overrides, you're going to want to find those overrides in here and delete them, right? So let's find our Schedule A itemized deductions. There's our charitable calculation override. We're going to delete that as a matter of course. We'll also do the same thing just to go through all of this best practice with this QBI deduction calculation. We're going to delete that. And I'll explain why we're going to delete all these in a little bit, but just to give you that rhythm of going through this process, we're going to delete them out right away. Not going to spend too much time worrying about QBI or the non-refundable tax credits for the purposes of this, but I will spend some time talking about the importance of this charity calculation override. All right, so just as a background, this particular client couple, this is a mid-career couple, late 40s, early 50s. They have a couple of kids. Most of their income is coming in from wages. They've got a little bit of interest and dividend and capital gain income going on here. But notice what happened here in this Schedule A itemized deduction section. All of their itemized deductions or anything that would have been on their Schedule A from 2020 ported over to 2021. So same amount of medical expenses, same amount of state or local tax, mortgage interest, and so on. This amount carried over too, right? So this used to read 25,450. Right? Now, if we just left this alone and we didn't change anything, they're going to have the same amount of deductions as they did the previous year. That amount of deductions exceeds the standard deduction for this year, so they would be itemizing with this particular one, right? You have the ability, if you just want to do a very fast modeling of charitable contributions, you can use this override box and type something in. We don't think it's necessarily the best way, but it is a quick way. So if we knew that in 2021, rather than $25,000, these folks were only going to donate $15,000, you could type it in here, right? So I've typed in $15,000. That obviously is going to change things, but we're still itemizing and we could be good to go. But why is this not a best practice, right? It's not a best practice because, as some folks have already alluded to, either in the Q&A or in the chat, one of the things that the charitable gifting rules tell you is that not all gifts are created equal, right? Not every deductible gift is deductible to the same amount. Your deductibility is going to be based as a percentage of your adjusted gross income, and the percentage is going to be determined by the nature of the recipient charity and the nature of your gift, right? Gifting cash and gifting appreciated stock or capital gains property very well could result in a different amount of a deduction based on how much you're gifting. Right? So that's an important concept that you don't really capture here, right? The nuance of that isn't captured if you just use the override field. So you might be asking, how do you do that? Well, the way that you're going to want to do that, if we're talking about, again, gifting cash, appreciated stock, or in some cases, non-cash assets, so potentially property or things like that. If you open this calculated charitable deduction field, which you can do by clicking on this green caret, you're going to see a whole bunch of different rows show up. These are the different elements where the different AGI or adjusted gross income limitations apply. So we've got things for if you're gifting what's called a qualifying contribution, which is something that came into play last year and is again in play this year, which is basically cash gifts for non-donor advised fund charities. Your charitable contribution deduction limit is actually 100% of your adjusted gross income. You can never over deduct, right? So you can't have a deduction that's greater than your adjusted gross income. But with this introduction of this qualifying contributions element, if you give cash to a non-donor advised fund, you can actually deduct up to 100% of your AGI. There's a special election that you need to do when you're doing your tax return. But for the modeling purposes, you don't need to worry about that. But here are some other ones, and these are the ones that are more applicable, especially for folks who have taken the CFP curriculum in our CFPs. You might remember this from way back in CFP school. You have this concept of a 50% limit organization and a non-50% limit organization. I'm going to take a brief aside to say most public charities, in fact, I believe all public charities are considered to be a 50% limit organization. However, if you're ever unsure if your client's charitable recipients are a 50% or a non-50% organization, you can look it up. So on the IRS website, there's an IRS website where they talk all about charitable contributions. They talk about what is a qualified organization, the limits on deductions, where the 50% limitation applies. So again, it's all public charities, all private operating foundations, certain private foundations, and things like that. If you're ever unsure, you can always run a search. If you click on this, it takes you to the tax exempt organization search, and each registered charity within the IRS database is going to have a deductibility status code to let you know, is it a 50% or is it a 30% organization? So this is kind of what it looks like. I ran one for stuff here. I live in Chapel Hill, North Carolina, so I just ran a quick search. And if I look at Uplift Chatham, I can see that this is a public charity, which means that it is a 50% or 60% for cash contribution, right? If it was POF, it would be a private operating. If it was a lodge, like a domestic fraternal society, which I believe is like Elks Lodge or things like that, that's going to be a non-50% or a 30% limit organization. So again, if you're ever unsure, you can type in the name of the charity within the IRS charitable tax exempt organization search and determine it on your own, right? So let's say, for the sake of argument, that I have a client that wants to give $100,000 to the United Way, and they've got appreciated stock. It's been a great 10 years, and they've got this stock or this ETF or this mutual fund, and they want to gift $100,000 worth of it. We know as planners that there's no difference ultimately on the charitable side. A charity can accept appreciated stock, sell it, and they get full use of those funds. They don't have to pay taxes because they're a nonprofit, good to go. But if I want to model that correctly, and my clients want to do this $100,000 gift, if I put it into this charity calculation override, Holistiplan will allow you to do a $100,000 gift, right? Why is that? Well, because you're overriding anything that's going to be calculated. But if we enter it the correct way, which is I'm doing a $100,000 gift to the United Way of stock, that's a capital gains donation to a 50% limit organization. If I type in $100,000 right here, Holistiplan will say, not so fast, right? You can actually take a deduction of about $83,944, and that will leave you with a $16,000 charitable carry forward. Now, unfortunately, we can't track the carry forwards for you, just like we're not able to track and apply tax loss carry forwards from previous scenarios. But if we're just concerned about modeling this year's particular scenario, this will be your calculated charitable deduction. But notice what happens. If I don't delete this out, I'm still using a $100,000 deduction. Once I delete this, though, Holistiplan will say, oh, wait, you don't get that full amount, right? You only get the 104,944 deduction. So the same thing's going to be true if you put in this $100,000 elsewhere, right? So we've got a 30% limit for cash and non-cash donations to a non-50% limit organization. If you donate appreciated stock to that fraternal lodge, so that 30% organization, you're going to be even lower, right? In terms of what you're actually calculated to do. So if we do $100,000 here to our non-50%, notice that we can only use almost $56,000 of it because we're limited to 20% of our AGI, right? So John asked a really good question, right? John, inside the Q&A, says, what's the best way to model the use of a donor-advised fund in these tables? So for those who are unaware, a donor-advised fund, and I'm going to do a little bit of drawing here, a donor-advised fund is in itself a 501c3 charity, right? So they're run by all sorts of institutions, Fidelity, Schwab, Vanguard, they all actually have them. Some non-brokers or non-custodian options are out there too. But the way that the donor-advised fund works, if we assume that this box is our donor-advised fund, your client can make a gift into the donor-advised fund. You can gift cash, you can gift stock, you can give some complex assets depending on the nature of the donor-advised fund. Some are better equipped to handle them than others. And in doing this, that is a charitable gift, right? Because you're gifting to the donor-advised fund. The donor-advised fund is the charity. And then out of the donor-advised fund, your clients can make grant recommendations to any other eligible charity. So this is a great way to make a large charitable contribution in a single year when your clients may not necessarily know where they want all the money to go, and they might not want to make all of that gift to one single charity in a particular year. So you give a little bit of flexibility using the donor advised fund. Well, a donor advised fund is a 50% limit organization. So if you are modeling gifts to a donor advised fund, you will put your dollar amount right there in that row for, assuming you're gifting stock, right? If you're gifting stock, it would be capital gains donations to a 50% limit organization. If you're gifting cash, it would be here, right? Cash to a 50% limit organization. Be very careful though. If you're gifting cash to a donor advised fund, don't put it here, right? Because gifts to a donor advised fund do not count as qualifying contributions, right? So John, hopefully that answers your question. Hopefully that answers questions for a lot of folks, because that's kind of one of the things that motivated us to start to run this particular webinar, is people modeling charitable contributions, not knowing how to do donor advised funds, and then just leaving everything inside of the charity, the calculation override. So Sean asked, what category are foundations? Well, it depends, right? So some foundations might be 50%, some might be 30%. If you know the name of the foundation, you're gonna wanna look it up to make sure you do it the right way. So look it up inside that charitable, the IRS's website. Now, that said too, most foundations, if they're large enough, they'll know if they're a 50% or a non-50%. So, the fact that Sean said that his was run by his client, your client might or should know if they're a 50% or a non-50%. But again, if they don't know, you can use that lookup tool within the IRS website to determine, are they going to be a 50% or a 30%? So a couple of other questions that are coming in. Will we be covering modeling qualified charitable distributions or QCDs? Yes, we will. We'll get to that in just a minute. Another question, where do we put the $300 or $600 above the line charitable donation for 2021? So great question. Let's clear this out. And we're actually going to go to a different household because we'll be able to model both we'll talk about QCDs as well as that $300, $600 above the line, below the line contribution stuff. So let's kind of come back to our households, and we're going to go to our retiree household. So Mark asks, is it safe to use a charity calculation override if the gifted amount is under 20% of AGI, or are there other reasons to enter the details? Yeah, I mean, again, if it's a small gift, less than 10, 20% of AGI, you're probably fine, right? Anything that starts getting up above that, though, we'd say, yeah, it's best practice to kind of do it the way that we just outlined it. Jeff asks, how would I model a non-qualified annuity distribution to a DAF? Well, if it's a non-qualified annuity distribution, I don't know that that can go directly to a donor advised fund. Not 100% sure, but my assumption would be that you would actually have to take that distribution and then gift it back to a donor advised fund. I don't know if it can go directly from a non-qualified annuity into a donor advised fund and not pass through the client's tax return. So you'd actually have to model a distribution. So you'd actually put that, and we can bring up our retiree person here. And I should say, let me put this, I'm going to put a few things in the chat box. So Maureen asked a question about the IRS publication that I'm referencing. I'm actually going to put this here. All right, so everybody can access that. That is the link to the IRS site that talks about charitable contributions, right? So here I am in my retiree household. I'm going to open up my scenario analysis. So if I'm modeling an annuity distribution to somebody, here I am in 2021 baseline. An annuity distribution would go into taxable pensions and annuities, and then you would actually have to model taking that distribution, and then on the back end down in Schedule A, model your contributions to a donor advised fund. Again, that sounds like just two separate things. It's not one smooth motion. So you'd be taking cash, and if you're going to take that cash and then send it back to a donor advised fund, that would be a cash gift or a cash donation to in this box right here. Again, that's for the non-qualified annuity distribution to a donor advised fund. So Rick asked a question, why do they call them 50% limit organizations when the AGI limits can be 30% or 60%? Shrug emoji. I don't know. I don't work for the IRS, so wish I knew the answer to that one, but I don't. Daniel asked the question, where do we put the $300 or $600 above the line charitable donation for 2021? So great question. Remember that the 2020 CARES Act brought into existence this above the line charity deduction, where if you don't itemize, you still could take a small deduction. Last year it was $300, and it would go on your 1040, and it was above the line deduction. So it actually happened before the adjusted gross income, right? In 2021, it changed a little bit. So the total amount changed. So now you can do up to $600 of a contribution. This has to be cash, has to go directly to a charity, can't go to a donor advised fund. So again, it's a qualifying set of qualifications. And now it's actually going to go down here, right? It's actually going to go down in this little box down here. And the reason for that is because it moved below the line, right? So it used to be above the line last year. This year it's below the line. So you'll just want to enter it down in this section, and it's going to make it look like it's added to your standard deduction amount. That's just a programming tool. So if we wanted to do a $600 charitable contribution this year, we just type in 600. Right, now we've got it down there. All right, so Daniel, that's your question answered right there. Now, this household, I picked them for a reason, right? I'm actually going to delete that out, right? So I've got a brand new household. I'm going to delete out my charitable override. I'm not doing anything. This house, the way that it is put together, so these folks are not yet taking required minimum distributions, right? They've got some dividend and interest income. They're taking Social Security. There's a little bit of long-term capital gains, but they're not taking IRA distributions. At least in 2020, they weren't. For the purposes of 2021, I'm going to make the assumption that they are, and that their required minimum distribution is with the first taxpayer, that he's got to take a $50,000 required minimum distribution, right? So this is my baseline now. I might look at this client and say, you know, you have the option, if you want to, of making a gift. Let's say they came to me and said, we want to do a $10,000 gift. What's the best thing that we're going to do? What's the best thing for us? I would look at this situation and say, well, okay, $10,000 gift. They don't really have any other itemized deductions. So if I do a $10,000 gift of appreciated stock, which is kind of what we're conditioned to think sometimes as planners, that's not really helpful. from a tax point of view, right? The charity is not going to argue anything, but from a tax point of view, that's not particularly helpful. I haven't changed anything, right? I might get a little bit of something, but not much, right? And in fact, let's get rid of, we're going to get rid of all that, right? So it doesn't do anything because that's not enough to push me over the threshold for the standard deduction, right? So what I might do instead is say, okay, well, what else do I have as a possibility? Well, I could do a qualified charitable distribution. A qualified charitable distribution, or a QCD, is a gift directly from an IRA to a recipient charity. You can't do it until you turn 70 and a half. Technically, you can't do it until the day you turn 70 and a half. So if you do it earlier in the year under the IRS rules, that's technically not allowed. But the way that QCDs work, that distribution doesn't count as income to the taxpayer. So it's never going to show up on the taxpayer's tax return. You also don't take a deduction for it, right? Because that would be double dipping. You don't get taxed on it, but you don't also get a deduction on it. The way you model a QCD in Holistiplan, and we'll just do this because I think this is sometimes a nice transition where you're sometimes talking to people about their different options. I'm going to create a second scenario here, and I'm going to call this 2021 QCD. And we'll keep it at $10,000 for now. All right. So there's no row for a QCD. If you've ever looked at one of your clients' tax returns that have done a QCD, what you see is a line, an indication in the taxable in the IRA distribution row that says QCD, and it does it for a particular dollar amount. Super frustrating to tax preparers because custodians don't really track this at all. They don't report it. They just report the total distribution from an IRA. So inside of Holistiplan, what you want to do is, rather than have this $50,000 IRA distribution, you'll just want to knock this down by $40,000. Now, here is where I would say make good use of the notes feature. So notice that every field that we've got here, there's a notes, this little post-it yellow notes section. So I might say RMD equals 50,000, if I can actually type, $10,000 QCD, right? Now I can look at my baseline and see, okay, if I do a $10,000 QCD, what's the actual impact? Well, my total income is going to be 10 grand less. My AGI is going to be 10 grand less. And my standard itemized deductions aren't going to change because remember, you don't take a simultaneous deduction for your $10,000 QCD. And what's the difference on my tax bill? Well, about $1,700, right? It's pretty good. Now, you can also use this. Let's say that we're talking about a larger dollar amount. Let's say it was a $25,000 charitable contribution. And we'll give these folks a little bit more of deductions here to work with to make this more interesting. Let's say that they've got $10,000 of medical expenses. So one of the things you're going to notice right away, notice that there's more deductible medical expenses on this QCD route. Why is that? Well, it's because medical deductions, deductions for medical expenses are based as a percentage of adjusted gross income. Because we've lowered adjusted gross income with a $10,000 qualified charitable distribution, more of this $10,000 amount is deductible, right? Let's also say, for the sake of argument, that we've got $5,000 of state and local tax, and we know our clients want to make a $30,000 charitable contribution, right? So we could model it one way with this QCD way. We'll change this to $30,000. We'll adjust our IRA distribution down. So it was 50. We'll now say that it's 20. So we've got a $30,000 QCD. And the reason why I'm doing all this is so that we can actually show like a significant enough comparison. Now we're going to copy from scenario 2, which is just going to be our baseline brought back over, but we're going to say 30K stock to DAF, right? Because that could be another option. You know, you could do appreciated stock to a donor advised fund. So we're going to keep the taxable IRA distributions at $50,000. I'm going to come down to Schedule A, itemized deductions. It's a $30,000 contribution to a donor advised fund. So I'm going to find capital gains donations to my 50% limit organization. I'm going to type $30,000 in there. Now I've got some interesting side-by-sides, right? I'm going to have a higher itemized deduction compared to these other two. Looks pretty good. I'm going to have a lower taxable income than my baseline scenario, but higher than my QCD scenario. My tax bill is going to be somewhere in the middle, right? So this is where you can start talking to your client. And again, I'm not saying that appreciated stock is always or never better than a DAF, but given the new rules about how much you have to do just to get over that itemized deduction hump, for folks who can take a QCD, you're most of the time going to see a bigger tax impact by doing the QCD as opposed to the donor advised fund route, because you're impacting adjusted gross income, right? And because the same dollar amount, unless you have other deductions here, unless you have a significant amount of other deductions that by themselves take you up to the standard threshold, the only amount that you're really effectively able to deduct is the amount of this charitable contribution that is in excess of the standard deduction, because you would get this anyway, right? So of this $30,000 contribution, you're really only deducting about $9,000, right? Because that's the amount that gets you to here above the standard threshold, right? That's kind of a big deal. So if not all of this is effectively deductible, it's only the amount that pushes above the threshold for the standard deduction. So that's why when you look at your baseline donor advised fund, baseline qualified charitable distribution donor advised fund, if all we're interested in is what has the lowest amount of tax in this particular year, in this case, the QCD route wins, right? I know that this is a lot. So Mark asked this question, don't forget the tax avoided with the appreciated stock donation by skipping the capital gains taxes. Absolutely, right? So this is just a snapshot. If all we're worried about is taxes in this particular year, that's one thing, but there are other considerations, right? One of the other considerations could be if I die under current rules with appreciated stock, I get a 100% step up, right? So couple of things going on here. So Roland Chow says, for the capital gains donation scenario, to be fair, don't you need to reduce the capital gains tax that would have to be incurred in the baseline scenarios? I'm not necessarily sure, right? I'm assuming that I've got capital gains that I could be, capital gains appreciated stock that I would be donating. If I've got that, I probably wouldn't ever just do a straight up cash. So I wouldn't sell to do a cash contribution. I would just donate my appreciated stock, right? So to your question, Roland, I haven't created any capital gains. I'm just using capital gains appreciated stock as my donation tool, right? So just looking into the chat, are appreciated stock gifts to a DAF a 50% deduction? Yes. So remember, donor advised funds are going to be capital gains donations. They're going to be a 50% limit organization. So you would put that amount in here, right? So I know that this can be a lot to remember. That's totally fine. That's one of the reasons why we're doing it. If you ever forget, we have over on the right-hand side, this tab called Scenario Recipes, where we put together our best practices for most of the common things that we see. And by we, I mean those of us that are in the support group. We see all of your emails and everything where you ask about how do I do this, how do I do that. Please keep doing those, right? We want to be here, we want to help you, we want to make you look great in the eyes of your clients. But if you ever want to do just a quick and dirty, I don't remember how to do that, within the scenario recipe box, we put together kind of the best practices for some of the stuff that we talked about and more, right? So here's some information about the AGI limitations, the importance of clearing the override field, expanding the calculation section, and then entering the amounts of each charitable donation type. Here's how you would model a donor advised fund, right? And here's how you would model a qualified charitable distribution. The way that this is put together is that you can scroll up and down within the scenario analysis itself, as well as over here on the scenario recipe, if this extends back to, beyond one screenable page, right? So some of the questions that were coming in: can you exercise a QCD from a qualified plan or just IRA plans? It's just IRAs, can't be SEP IRAs, have to be over 70 and a half, and it's got a maximum of $100,000, right? So you can't do a QCD of over $100,000. That's a per taxpayer. Okay. So did you show how to model a 2021 tax return that has a carryover from 2020? No, I didn't, but that's a great question. So if you know, and so this is John Munson, that's a really good question. So when you create a charitable carry forward, unlike capital losses, which can be carried forward in perpetuity, charitable carry forwards can only be carried forward for 5 years. Right now, that's a long time. Now, again, we can't keep track of that for you. But John, to your question, if you have carryover from 2020, you'll want to enter that into the appropriate box as if it was a charitable gift in this current year. So it'd be really helpful if you knew the nature of that gift. Hopefully you've got the return that shows you where that generated from, and you go ahead and put it into one of these boxes, right? You want it, the carry forward retains its nature. So if it was carry forward that was from a capital gains donation to a 50% limit organization that gets carried forward, it should go in this box, right? It shouldn't go in any of these other boxes. It can get really tricky when you have multiple different types of contributions and organizations, recipient organizations. I'm not going to go into it today because it gets really technical, but do know that if you have multiple things going on in here, we do calculate the right amount of what you're allowed to claim, right? There are some rules about, like, if you do it to this particular organization, well, this AGI limit gets filled up, but then this one doesn't get applied, and then you got to do it to this one, and then it's 50% what's left over. All of those rules, by the way, they're available on the IRS website. I think it's publication 596 that goes into all the details for charitable contributions. But there's this worksheet that is really gross. But if you want to take a look at it, you can. That goes into the ordering rules for where things get filled up first and things like that, right? So John, hopefully that answers your question. Yeah, so John, actually, prior returns typically show you the nature of the carry forward. IRS publication shows the stacking rules on what gets deducted. Absolutely. So again, I think it's publication 596. I might be getting it wrong. Oh, 526. There we go. So I'll put a link to this in the chat as well for folks who for whatever reason really want to get into the nitty gritty. But you can do that in here, right? Okay. So Madeline, I'm going to ask you to unmute yourself. I know that there were a lot of things that were coming through on the chat. Was there anything in particular that I haven't addressed? So here, Clifton Kirksey, if doing a DAF contribution, will the software calculate the 60% limitation of AGI, or do I have to? No, you do not have to. You just put in the total amount, we'll calculate it for you. So again, if this is our DAF example, because it's capital gains to a 50% limit organization, let's say we wanted to do a $500,000 gift. That's the calculated amount, $33,627. This 466 is what you could carry forward. And then we've already figured in to this itemized deduction amount that you were only able to do $33,000, right, Clifton? So that answers that question. Yeah, so charitable remainder trust, that's a little bit different. It's a little bit more complicated beyond the scope of what we were going to be talking about here, but that has to get into the present value of the remainder interest, and then that's going to be your deduction amount. I'm going to tell you right now that when you want to do that, you're going to want to work really carefully with your client's estate planning attorney and their CPA to make sure that you get all of those rules correct, right? So Madeline, anything that we've missed, anything that I haven't touched on, or interesting things that came up that I missed because of the deluge?
We did have one that was about QBI, though. It's not about charitable giving. Other than that, though, I think most of them have been answered. We're getting a few more though now.
Yeah, so Joe, for the charitable remainder trust deduction, again, I think you're going to want to look at the nature of what you're actually putting into that charitable remainder trust. And I can actually, we'll look into that and get back to folks, because right now I just want to make sure we get that right. So Daniel asks, can you review where to put DAF cash and non-cash donations again? Yeah, so again, contribution to a donor advised fund, of appreciated stock is going to be a capital gains donation to a 50% limit organization. If you're gifting cash, it would be cash donated to a 50% limit organization for a donor advised fund. Right. So David asks, if I'm trying to model a client that has a $300,000 capital gain donation, 50% carry forward, wow, and is interested in using this to offset his Roth conversion, how do I figure in IRMA in this? Great question. So your adjusted gross income is going to be happening before you get to those deductions, right? So your IRMA is going to be based on this. So you can do all the deductions that you want to, but you can't do a deduction. You can't do a charitable gift to reduce the IRMA impact. What you theoretically could do, depending on the age of this client, would be if there is there a QCD that's going to impact the AGI, right? So anything that's going to go into an IRMA calculation has to effectively be above the line, right? So it's going to be something that is just a reduction of income because the income's not as high, or it's going to have to somehow end up on Schedule 1 as an above the line deduction, right? How do we use the cash and non-cash donation field to a 50% organization? So the 50% organization, so non-cash. So I want to make sure I understand this, right? So we've got cash to a 50%, non-cash, non-capital gains donations to a 50% organization. So this would be like, I think, a conservation easement, right? So it's not cash, it's not a capital gains asset. Could be like a van or a car, right? A used car that you might donate to your public to the public radio, something like that. So a non 50%, that would be right here. So again, cash, non-cash, you would just put it in the same section right here. Again, make sure that you're actually doing a non 50% limit organization, but you would just enter that into that field right there, right? How would you model a cash DAF contribution paired with a Roth conversion to offset the taxes? So great question. So this one came in from Clifton. So what I would do would be to say, and let's just say that I've got my baseline right here. If I've got a Roth conversion, I'm going to find my Roth conversion row. And I'll say, I don't know, I want to do a $50,000 Roth conversion. I know that that's going to increase my donor, my total income right here. And then if I wanted to say how much would I need to do to offset the taxes on that relative to the baseline, that's a great question. I actually don't know that we could manually, or that we could calculate how to do that, but then you could come in here and do, again, I'm going to do a $50,000 Roth conversion, and I might do a $60,000 donation. So again, I'm not going to get to Clifton if you're trying to say like, how do I do it to completely offset the taxes? We don't have a button that you could push that would just say, here's how much I would need to put in. It's kind of a neat idea, but that's how you would go about doing it. Right? All right. So I know that there were a couple of questions about charitable remainder trusts. Look into that and see if there's anything in particular. I don't know that we could do a full session on that and fill it, but I do know that there were a couple of people that had a couple of questions about that. So those are good questions. All right. Anything else? This has been really good. I want to appreciate everybody's time and attention to this. We wanted to get this done before we get to the end of the year, partly because if you're thinking about doing a donor advised fund for your client, you kind of need to do it now, right? Because it takes time to get the DAF set up, but then it's also going to take time to get the stock or get the thing out of where it currently is to that donor advised fund. If you're working with custodians, particularly some that have been under a little bit more scrutiny as of late, you'll know that the timing of service requests is being very much drawn out, right? So the earlier you can do this, the better, because all that stuff has to happen in the calendar year, right? You can't have started it, but not have it finished until January 5th and have it count for 2021, right? So the gift has to be out by calendar year, end of the calendar year. So if you're thinking about doing this or your clients are on the fence, you got to light a fire and motivate, because otherwise you do run the risk of you're getting into where custodians are going to tell you they're at best efforts instead of guaranteed execution, right? Oh, I like this part. Now I'm looking over and seeing all the things in the great presentation. This is my favorite part, Madeline.
I know. It's been nice.
Yeah.
We're glad you guys enjoy it.
Yeah, thank you so much. We'll stick around for another minute or two if folks have questions, but otherwise, thank you so much for your time. And again, we'll send out a recording of everything once it's good to go. If you don't get that today, it'll be coming sometime tomorrow.
And if we end the call and you find yourself 20 minutes from now remembering a question, feel free to reach out to us after too.
Yeah, for anybody who hasn't, again, I'll just do a little quick plug for the support folks. We're only an email away. So if you want to contact us, just as a best practice, we always encourage you to hit the contact support link that's on the page where you have a question. The reason for that is because on our end, we get a link that takes us right to that page, right? So instead of taking us to your household page or just a general page, if I had a question about this particular scenario analysis, I'd want to hit my contact support link right here. This one is kind of funny, and I kind of want to change this, Madeline, but we get so many of these. This is supposed to be the subject of your request,
we definitely need to change it.
As opposed to the title. We get so many of these that come in like financial advisor. I'm like, oh, okay, but we really want to know the subject of what you're trying to say. And then just a quick description. You can also look over here on the help side. So again, you can get to the contact support, but there's also the knowledge base. So our knowledge base is searchable. It's got all sorts of things that you can look at. So we can look at a whole thing for charitable deductions right here. You can do, again, all searchable. So qualified charitable distributions, how you can model it this way. So again, it's the same sort of stuff that's going to be in those scenario analyses. Maybe it's going to be written out a little bit more here, but the scenario recipes is kind of a nice feature because you can do it again within the context of the scenario that you're looking at. So Roland asked one last question. So for the non-50% organization, there's no differentiation between cash and non-cash contributions, right? Right, so cash and non-cash to a non-50% right there. Right, capital gains are going to be the only ones that are going to get that special 20% AGI limit. Right.
Then Anna asked if you could show where the scenario recipes are again.
Absolutely. So far right-hand side, scenario recipes. You just click on that arrow, and then you'll get this drop-down menu where you can look at anything. So we only talked about, charitable stuff, but there's stuff in here too for how to do a Roth conversion, right? That's the next biggest thing that we get. How do I do a Roth conversion? We'll get, how do I model contributions to retirement plans? So, how do I model 401k contributions, or how do I model SEP or solo 401k contributions? So stuff like that. So Clifton asks, are most advisors using the software in scenarios in person with the clients? I don't really know. I think it depends on the client. So I don't think I mentioned this, but I'm still a practicing advisor. I have a small RIA here in Chapel Hill. And my use of, I rarely show scenario analysis with my clients. I think there's just too much on here. It's too busy. But depending on the client and their interest level, sometimes I'll show the range calc. So for folks who aren't familiar, range calc is our superhero of Holistiplan. So within range calc, and again, I know we're going over scope. So if people want to bail because we're talking about stuff that you're already aware of, no offense taken. But within range calc, what you're able to see here are the impacts of adding additional increments of, say, ordinary income or long-term capital gains to your existing scenario. So the scenario that took you here, right? I might show this to some clients because I think they'll find it interesting. And sometimes it can be illustrative of, here's why this is as expensive as it is to do a Roth conversion when you're in this little zone right here where your effective rate is actually 27%, even though you're only in the 12% marginal bracket. I realize as I'm saying that, I might be opening a can of worms that people want to talk about. If you have a question about why this is, come to the office hours next week. We're not going to talk about it here. So I might open this up for some folks, but not for everybody. So that's a good question, Clifton. Oh, I wanted to mention one last thing. I forgot about this. So if you are on one of the plans, premium plans, so anything that is basically above the $4.99 subscription, you do have the ability to create tax letters for your clients. So a tax letter, the way we think about it is just, it's a summary of all the things that you did for a client that are tax related over the course of a year. Really helpful when the tax documents that are coming from your client's custodians aren't always as clear as they'd want to be. So like, and let's actually, we can use this one, it doesn't really matter. It's kind of like a CRM type feed where you can do a recording of the tax related things that you did. So that here we've already modeled Roth conversions, gave to a donor advised fund. This is really simple. You just click the plus button, you select the thing that you did, give it a description and an amount, and you save it. Early next year, you might hand this to your client or your client's CPA and say, here are the things that we did, right? Here's the Roth conversion that we did. Here is the gift to the donor advised fund that we did. Here is the HSA contribution that we know that you made. Here are the documents that you should be expecting, right? It's a really nice value add for your clients as they're putting their stuff together to do their taxes, or super nice value add to a CPA to say, I know you're busy. I know clients mean well, but they don't always give you the most accurate information. Here are the things that you should expect from our mutual client as they're putting stuff together. Here are the documents that you should be expecting, and here are the things that I know about that we did. Really helpful on the qualified charitable distribution side, because again, the 1099-R that you're going to get from your custodian isn't going to have any indication that some of the distribution over the course of the year went to a charity, not to your client. You're kind of relying on the taxpayer to keep track of that. So Eric asked, how did I get to that range calc? So if I'm inside of scenario analysis, and again, it's going to look a little bit different, Eric, because I'm in a different household now, but I just click the range calc button at the top of the column, right? So I would just click range calc right here. This one's going to look a little bit different because it's got a different situation going on, but you'll see impact of additional ordinary income from the marginal bracket. In this one, you'll see a little bit of net investment income tax. And because these folks have 2 kids, if they add enough ordinary income, we start phasing out the refundable child tax credit, right? Once they've added about 120 some odd $1,000 of ordinary income, right? All right. This is great. So again, I'll stick around for another minute or two if folks have additional questions. But I'm starting to see our participant count drop, Madeline. So where we had that awesome breaking of the dam and everybody flooding in, the dam's being built back up and people have to go about their day.
Yes, Chris, this has been recorded.
Yep. So this has been recorded. We'll send the recording out to everybody who registered, whether you were able to spend just a little bit of your day with us or the whole hour. You'll have this recording in perpetuity. All right, well, I'm going to go ahead and stop sharing. Again, thank everybody for your time today. And if you want to see more stuff like this, just let us know inside the support channel. If you want to see more, again, specific things with inside Holistiplan away from the office hours, which is kind of a free for all. We want to make you really comfortable with the product. So we're happy to do that sort of thing. So